Welcome back, accounting boffins. We're busy with the cash budget. Remember, just to give you a quick recap of what we were doing, we were calculating the missing figures, and there's the missing figure that we needed for our salaries, just to show you that that was what we calculated as our missing figure for A. Right, now we're calculating our payments to creditors. Okay, and this is what we do. The business keeps a fixed base stock of 175,000 Rand. Goods are replaced monthly. That's what we mean by a fixed base stock. Goods are replaced on a monthly basis to ensure that we start off the next month with the same amount of stock that we had at the beginning of the month. Okay, the business uses a markup of 100% on cost. That's the markup. 35% of all stock is purchased on credit. Creditors' terms are strictly 30 days. The business complies with these terms. So all of these are important considerations because they guide you as to how you will make your payments. Very important. Okay, so now what do we know? This is the information that we have, right? And we want to calculate our B. So immediately we say, fine, let's look at our September figure of 200,000, right? There's your actual sales figure, 200,000. Now remember, when it comes to payments to creditors, you need to determine your cost of sales, right? Very important. Determine your cost of sales. So what do? Step number one, take your 200,000, which is your cost, your selling price, times 100 over 200. Remember, I showed you this before. I'm going to show you again. You take your cost price over your selling price times your actual selling price, and therefore it's 100, which is my cost, over my selling of 200, and that gives me a figure of 100,000 Rand. Okay, that's the first part of your calculation, determining your cost of sale. Right. The second part of your calculation would be, how do you pay? You're saying that 35% of all stock is purchased on credit. Creditors' terms are strictly 30 days. So if 35% of your stock is purchased on credit, then this is what we're now going to do. Watch. 35% times over 100, that means 35,000 Rand is the figure that you are looking for. And therefore, when you slot in your payments to your creditors, you can clearly see that that is the 35,000 Rand that you are looking for. So once again, let's recap. When you're working out your credit purchases, step number one, take your total sales figure. Calculate your cost of sales. Once you have your cost of sales, you split it up into cash purchases and credit purchases. Your credit purchases will determine how you pay your creditors. Okay, moving on. Now we have to calculate, this is what our debtors are granted 30 days to settle their accounts. The payment is 75% of all sales are on credit, and it is projected that our sales will be, for September, will be 180,000. Remember, we're calculating C. Let's go back into C. What is it that they wanted in C? They wanted our cash sales for November. There we go. Right. So if we're looking at the cash sales for November, remember what we want to do? We want to look at, immediately take into consideration that you have a figure that's given to you. We were given here. Here's the figure. The projected sales, credit sales for September was 180,000 Rand. You looking at the component where you want the cash sales component. So obviously, if 75% of your sales are on credit, that means that you now have to use that figure that you have to calculate your missing figure. Watch. You take your 180,000 Rand times 25 over 75. The reason you are doing this calculation is to determine, watch here, let's just have a clear indication of what we have here. we want our cash sales for November. That's the figure that we're looking for. Okay, and we always take into consideration that this is the information that you have regarding all your sales figures, and therefore, when you're working out, you calculate using the 180,000 Rand, and because you have the credit sales component, you can now calculate your cash sales component, because that is what we are required to calculate, our cash sales component. Remember, using your credit sales, you work backwards to calculate your cash sales. And therefore, you would find that you would end up with a cash sales figure of 60,000. There we go. There's my cash sales for November. Okay. So this calculation tells you that you have to use given information, right? And using the given information, you go back to calculate the figure that you are looking for. So if you are given your credit sales, you know that that equals to 75%, therefore the cash sales would be 25%. And that is why the calculation looks like this here, right? Where the credit sales component was 180,000 Rand, obviously based on the information, here's it here, you can clearly see projected credit sales was 180,000 Rand. Therefore, using that, you can calculate your cash sales figure. Therefore, you have a cash sales figure of 60,000 Rand. Okay, so there we have now completed calculations. That was A, that was B, and that was C. So we have completed the missing figures that we needed to calculate in our cash budget. Okay. Back to our information, Livewire traders. Now there are certain aspects that Debbie Prince is concerned about. Let's look at her concerns and let's see if we can help her. Comment on the cash and credit sales. Explain how these amounts are affecting the cash flow of the business. Quote figures. My appeal to you, my humble appeal to you, is whenever the question says quote figures, you have to use figures from the given question to support your answers. Okay? That is important. So here we go. Our cash sales, we budgeted 55,000 for August, but it's only 42,000. Your credit sales, you budgeted 135,000, but your actual was 180,000, right? Your collection from your debtors was budgeted 141, you only collected 86.5, and then obviously advertising, you budgeted 11, but you actually spent 22,000. Okay, now, obviously, if you look at cash sales had a negative variance. What do we mean by a negative variance? Let's go back and see that. Cash sales, negative. Why? Because your actual was less than your budgeted. So clearly you can see it's a negative variance. You budgeted to receive or to have cash sales of 55,000, but you only had 42,000. So you had less. The actual is less than the budgeted. In this case here, a negative variance. Then the reason is the variance is 13,000 Rand, and where does it come from? The actual amount was 42,000, but it is less than the budgeted of 55. So in other words, if you take 55,000 minus your 42,000, so you're taking your budgeted of 55, actual of 42,000 gives you a variance of 13,000. This is what we mean by the variance. In this case, a negative variance, meaning less than the budgeted amount. Okay. The credit sales, on the other hand, had a positive variance, meaning of 45,000 Rand. What does it mean? It means that the actual amount was 180. So your budgeted was 135,000. That's what you budgeted for your credit sales. Your actual was 180,000, giving you a variance of 45,000, meaning in this case here, a positive variance, meaning that your actual was more than your budgeted. And you can clearly see it here. Let me show it to you. Here, your actual was 180,000 and your budgeted was only 135,000, indicating to you that you had a positive variance. Okay, now, clearly you can see more customers were buying on credit as compared to cash sales. Now, what will this will have resulted in a surplus of cash for August. The bank balance will increase, obviously, by 32,000. How do we get that figure? Your 45,000 minus your 13,000. Clearly, you can see that these are the fact that you have budgeted and it is different to your budget, means it's going to impact on your cash balances. Has the advertising campaign been beneficial to the business? Explain and quote figures. Once again, let's look at our advertising campaign. We budgeted 11,000, we spent 22,000. Therefore, yes, the actual advertising amount of 20,000 has been doubled, right? Has actually doubled from 5% to 10%. The sales is increased by 32,000 Rand, which is an increase of 14%. Therefore, the increased advertising did not increase it had an impact on part of your sales, and it had a negative impact on the other part of the sales. So you can clearly see that one part of your sales increased and the other part of your sales decreased. So obviously, it means that it certainly had an impact, but two different impacts if we're looking at your cash sales and your credit sales. Do you think that the collection from debtors is well controlled? Once again, let's look at our information. Collection from our debtors, we budgeted 141,150. We only received 86,500. Okay, so immediately you can see there's a negative variance. Why? We were supposed to receive, we budgeted to receive 141,150, but we only received 86,500. Okay, now, no, the collections of 86,500 are much lower than the expected 141,150. Again, look at what we're saying here. There's your budgeted figure, 141,150. There's your 86,500, which is your actual. So this is your budgeted figure, and this is your actual figure. Clearly you can see that because your actual is less than your budgeted, it would definitely cause cash flow problems. In other words, it means that in your cash budget, you're expecting to receive a certain amount of money, but here you are not receiving what you budgeted to receive, and therefore the variance is 54,650. You're receiving less than what you had budgeted for. Clearly, this is going to indicate to you that this will result in cash flow problems. How would we solve this problem? What can we do about it? Because clearly, the idea of a cash budget and a debtors collection schedule is to plan, is to forecast, to see how we can improve. How are we going to improve? One, ensure the debtors adhere to the policy by notifying them of the outstanding balances via WhatsApp, via SMS, whatever social media we can use, technology that we can use, informing them of their outstanding debt. Two, charge interest on overdue amounts. That means where a debtor is not settling his account timeously, you charge interest. That means you increase the amount that they have to pay you. You do not allow for future credit to debtors who do not adhere to the required credit policy. In other words, if a debtor is not complying, then certainly you need to take some action. right? So you stop, say, okay, you, debtor A, you're not complying with the credit terms, you're not complying with the credit policy, therefore, we're going to stop all credit to you, no more credit to you until you come to the party, you start settling your debt, and then we will revisit your credit policy. So action needs to be taken. So understand, people, and this is important. One, it's not just the calculation of the cash budget and the debtors collection schedule, and it's something that you put aside. No, it requires action to be taken. And this action will ensure that we do not experience any cash flow problems. Okay, that brings us to the end of our lesson today. Let us recap and summarize what we have done in today's lesson. Number one, we looked at the primary differences between your cash budget and your projected income statement, right? So we clearly saw what items would feature in your cash budget and what would go into your projected income statement. Then we visited our receipts from our debtors, where we looked at the debtors collection schedule, and we saw how we have to look at the calculations in terms of how are we expecting our debtors to pay us, what percentage in which month, and then obviously we did the calculations, so we updated the debtors collection schedule. We also looked at the creditors payment schedule, and you saw that like your debtors collection schedule is dependent on credit sales, your creditors payment schedule is dependent on credit purchases, but before credit purchases, it's dependent on the cost of sales because we are using base stock, right? We then went on and we calculated certain missing figures in our cash budgets, and then we looked at variances. It means the differences between actual amounts and budgeted amounts. And more important, once we've calculated the variances, what actions are we taken to, what actions will be taken to prevent cash flow problems and other challenges that may occur as a result of the variances that we have identified. From me, Ashraf Patel, and the team, until our next lesson, keep your feet on the ground, reach for the stars, and always be an accounting shining star. Goodbye.